Welcome to Delphos Insights.
It's a pleasure to be here for this discussion.
Today we're going to tackle a number that is, well, it's so large it almost feels abstract. $4.2 trillion.
That's right. And that's the estimated annual financing gap to achieve the Sustainable Development Goals, the SDGs in emerging markets.
Every single year. That's what's so staggering.
It's an incredibly difficult figure to really visualize. I mean, to put it in context, that's significantly larger than the entire GDP of the United Kingdom.
And that's not even the total cost, right? That's just the gap.
Exactly. The amount of money that's missing from the equation to build the necessary infrastructure, healthcare, energy transition systems, all of it.
So that's the starting point for our deep dive. For a long time, the global strategy was sort of built on this assumption that governments' official development aid would step in and fill that hole.
An assumption that's no longer valid.
Not at all. We're looking at the 2026 Guide to Private Capital Mobilization in Emerging Markets, and the data is telling a very different story.
It's not just invalid, it's become mathematically impossible at this point. We're in a bit of a pressure cooker situation globally. Governments are facing severe fiscal constraints.
And that's showing up in the aid numbers.
It is. If you look at official development assistance, or ODA, it's actually shrinking. In 2024, ODA dropped to about $212 billion. That's a 7.1% decrease in real terms.
And the projections for 2025 aren't looking any better.
No, quite the opposite. Projections suggest a further reduction, maybe down to somewhere between 170 and 186 billion. So right when we need to accelerate investment, the traditional public taps are running dry.
Which sets the stage perfectly for the mission of this deep dive. If the public checkbook is closing, who picks up the tab?
And the guide we're analyzing argues there's really only one viable solution.
A massive structural shift toward mobilizing private capital. We're talking about the trillions of dollars sitting with pension funds, insurance companies, large institutional investors.
That's the only pool of capital that's deep enough to actually matter. But the challenge has always been, connecting that money to the projects that need it.
So the theme here is this big transition, moving away from reliance on shrinking public funds to a model where public institutions leverage their own money to unlock all that private money.
Exactly. It's a shift from direct lending to what the industry calls catalytic mobilization.
Okay, so let's clarify the players. When we say public institutions, we're mostly talking about development finance institutions, DFIs.
Right. Organizations like the International Finance Corporation, the IFC, or the U.S. International Development Finance Corporation, the DFC.
And historically, their role was pretty simple. They'd find a project, lend it money, and wait to get paid back.
Correct. That was the direct lending model. It worked well enough when the gaps were smaller, but the new model, the playbook for 2026, is fundamentally different. It's about using the DFI's money to make the environment safe for others to lend.
So they're not just the lender anymore. They're more like the architect of the deal.
That's a great way to put it. Instead of saying, I'll lend you $100 million, they're saying, I will take the riskiest first $10 million so that private investors feel safe lending the other 90.
And we're seeing proof that this is actually working. This isn't just a theory anymore.
Not at all. The guide highlights that the IFC, as of late 2025, committed over $750 million in new mandates, energy, agriculture, that sort of thing. But the impressive part is that their partners pledged to co-invest enough to scale that up to a total of $8 billion.
Wow, that's a multiplier of more than 10 to 1. That's real leverage.
It shows the power of mobilization. And it's not just them. The European Bank for Reconstruction and Development, the EBRD, mobilized about 27 billion euros, roughly $31 billion, in private capital in 2024 alone.
The whole institutional machinery is finally pivoting to this new way of thinking.
It has to.
And the mechanism driving a lot of this is blended finance. It's a term that gets thrown around a lot, but could you just break down how it actually functions here?
Sure. Blended finance is essentially the art of combining public or concessional capital with private commercial capital.
And concessional just means money that's okay with lower returns or higher risk to get a certain job done.
Exactly. In a blended structure, this public money acts as a kind of buffer. It might take the first loss position. So if the project loses money, the public capital absorbs that initial hit.
Protecting the private investor's downside.
It completely transforms the risk profile of the deal. A project that maybe looked like a gamble suddenly looks like a stable, almost investment-grade opportunity because the DFI has absorbed that volatility.
That leads us right to the biggest hurdle the guide mentions. If the mechanism is there and the opportunity is there, why have private investors been so hesitant?
It all comes down to two words: perceived risk.
And the key word there is definitely perceived.
It's the gap between what investors think will happen and what actually does. This is where the data gets, incredibly revealing.
How so?
Well, if you look at sovereign credit ratings for many emerging market countries, they imply a default rate of around 14%.
So if you're a conservative pension fund manager in Zurich or Chicago, you see that number and you walk away.
You have to. You can't justify that kind of risk to your board. 14% is a huge barrier.
But the guide suggests the reality on the ground is different.
Drastically different. It highlights that the actual private sector default rate, so we're talking loans to infrastructure projects and companies, not the governments themselves, is only 3.6%.
That's a staggering discrepancy. The market is pricing risk at 14%, but the historical reality is under 4%.
It is. And it gets even better for the investor. The recovery rates for these loans, so the amount of cash you get back if a default does happen, average 72%.
So even when things go wrong, you're getting most of your money back.
The vast majority.
This sounds like a massive market inefficiency. Capital is staying on the sidelines because of, well, a ghost story, basically.
That's a fair way to put it. And that's why one of the primary recommendations in this guide is just to disseminate the data. Specifically, GM's data, the Global Emerging Markets Risk Database.
Which the DFIs have held internally for a long time.
For decades. The argument now is that they had to broadcast it. When investors see the real math, the so-called risk starts to evaporate and capital can flow.
But a spreadsheet alone isn't enough, right? You can show an investor great default rates, but if they're worried about the legal system, they still won't invest.
That's right. This is where the enabling environment comes in. The guide stresses that you need a stable regulatory framework. Investors need to know contracts will be enforced, and increasingly, they demand clear ESG standards.
Environmental, social, and governance.
Exactly. The big European and North American funds have their own regulatory requirements back home. They can't just chase yield, they have to prove compliance.
So the DFIs play a crucial role there by enforcing those standards, giving private investors the sort of ESG stamp of approval they need.
It de-risks the project on multiple levels, not just the financial one.
Let's shift to innovation in the financial structures themselves. The guide talks a lot about securitization. Now, usually when people hear that word, they think of the 2008 financial crisis.
Subprime mortgages? Absolutely. But context is everything. In development finance, securitization is a powerful tool for standardization and scale.
How is it being used here?
In late 2025, the World Bank Group did a major transaction. They took a big bundle of IFC loans worth about $510 million and repackaged them into rated securities.
So loans to different projects in different countries all bundled together. Why is that so important for, say, a pension fund?
Well, think about the logistics. That pension fund can't afford the time or money to do due diligence on one solar farm in Vietnam. It's too small, too specific. But if you hand them a AA-rated bond that represents a slice of a diversified portfolio of those loans.
That's a product they buy every day.
Precisely. It turns a bespoke, complicated project into a standardized commodity they can understand. It lets them participate passively.
This connects to a strategic shift the guide calls the originate to distribute model.
Yes. So historically, DFIs were like warehouses. They'd originate a loan and just store it on their balance sheet for 15 years. That ties up their capital.
But in this model,
In the originate to distribute model, they become more like factories. They do the hard work of originating and structuring the deal, but then they bundle it and sell it off, distribute it to private investors.
and that frees up their cash to go and start the next project.
It increases the velocity of their capital. The guide points to the IFC's MCPP, the Managed Co-Lending Portfolio Program, as a huge success story here. It's raised over $19 billion. It proves that institutional partners are willing to trust the DFI's diligence and buy the end product.
I want to ground this in some real-world examples. The guide provides some compelling case studies where Delphos was involved. Let's start with the on AX Alephsis shipyards in Greece.
A fascinating case of industrial rehabilitation. Delphos advised on a $125 million senior debt facility from the US DFC. This wasn't just about repairing ships, it was a complete modernization.
To handle more ships per year.
Roughly 200. But there was a green energy component as well, which is crucial.
The 30-megawatt solar plant.
Yes, a perfect example of blending infrastructure needs with the energy transition. The key lesson there is about tenor, the length of the loan. Commercial banks are often reluctant to lend long-term for a turnaround like this. The DFC provided that long-tenor debt, giving the shipyard the runway it needed.
It shows how public backing can revive critical infrastructure. Then there's the Suma Airports project in Sierra Leone.
Right, a $150 million loan for airport infrastructure. What's interesting here is the platform approach. Instead of treating it as a unique one-off deal, they use a standardized concession structure.
And why does standardization matter for an airport?
Because it makes the asset liquid. By using standard contracts, ensuring ESG transparency from day one, they created an asset that can eventually be refinanced or securitized. They built it with the exit in mind.
Let's look at the financial sector. The Kazna tech case in Egypt involves fintech, a very different animal.
Kazna is a neobank focused on financial inclusion. Delphos assisted in their capital raise. Fintech in emerging markets offers huge growth, but, comes with high risk.
So the solution was, again, blended finance.
Exactly. They utilized first loss guarantees. So if loans Kazna makes don't get paid back, that guarantee kicks in and covers the initial losses. This safety net gave private fintech investors the confidence to come into the deal.
Finally, let's touch on Meta in Central America. This was focused on agribusiness.
Agriculture is notoriously hard to finance because it's so fragmented. You're dealing with thousands of small farmers. The transaction costs are prohibitive.
So how do you solve that?
The innovation was a fund-of-funds structure. Instead of the DFI lending to every farmer, they lend to a fund, which invests in financial intermediaries, who then lend to the farmers. It aggregates the market and makes it investable.
In all these cases, the common thread seems to be that the public institution didn't just write a check. They engineered a structure that allowed private money to flow in.
That is the very definition of catalytic capital. They provided the structural integrity that made the whole collaboration possible.
Looking ahead to 2026 and beyond, the guide outlines a strategic roadmap, but it identifies a bottleneck that might surprise people. It's not a lack of money.
No, the world is awash in liquidity. The bottleneck is a lack of bankable projects.
That's a term we hear all the time. What exactly makes a project bankable?
It means the project meets the strict criteria of international investors. You might have a brilliant concept for a wind farm, but if the land rights aren't clear or the power purchase agreement isn't legally watertight, no international bank is going to touch it.
It's not investment ready.
Precisely. And this is where the role of advisors becomes absolutely critical. The guide is emphatic that you can't just figure this out as you go. You need specialized firms to structure the capital stack, ensuring the deal meets international standards before it ever goes to market.
So let's run through the to-do list. The guide lays out for DFIs in 2026. What are the core recommendations?
The first is utilize data. As we discussed, get that GEMS data out there to fix the risk perception. The second is standardize. We have to stop creating bespoke, one-off structures for every single deal. If you want scale, you need replicable financial products.
And the third?
Guarantees. Shift focus from lending cash to providing insurance against non-payment. A guarantee leverages the balance sheet much more efficiently. And finally, early advisory. Bring the experts in at the concept stage, not at the end.
There's a quote in the guide from Bart Turtleboom, the CEO of Delphos, that really seems to encapsulate this. He says, "The coming decade will favor DFIs that focus on standardizing, replicating, and distributing risk instead of continuously creating bespoke structures on a deal-by-deal basis."
That's the fundamental takeaway. It's a massive cultural shift for the industry. For a long time, development finance was viewed as this innovation exercise, where doing a unique, complex deal was the goal.
But to close a $4.2 trillion gap, you don't need artisanal finance.
You need industrial scale finance. You need an assembly line of bankable projects. It's about industrializing the process of doing good.
So bringing this all together, we started with a frankly terrifying number, a $4.2 trillion annual gap. But we've walked through a playbook that suggests this is actually bridgeable.
It is, but only if we embrace this new model of collaboration.
Right.
We're seeing a convergence where the goals of development, poverty alleviation, climate resilience are aligning perfectly with the needs of private capital, which are diversification and yield.
The tools are there: blended finance, securitization, guarantees. And the data exists to prove that the risk is manageable. It really comes down to execution.
And changing the mindset from aid to investment. And that leads me to a final thought I'd like our listeners to consider. We often talk about development as a cost, as charity. But if the actual risk in emerging markets is 3.6% and the perceived risk is being priced at 14%, Are we witnessing the greatest arbitrage opportunity of the decade?
That is a powerful way to frame it.
It suggests that solving global challenges isn't just the moral thing to do, it's the smart trade. It is a market inefficiency that, once corrected, could generate significant returns while simultaneously solving these massive global problems.
It turns the entire narrative on its head. It's not about giving money away. It's about capturing value where others are still too afraid to look.
Precisely. The smart money will figure this out, and the DFIs are providing the roadmap.
So here's the question for you listening. How can your organization leverage these new standardized frameworks to turn global challenges into your portfolio's next big opportunity? Are you looking at the real data, or are you still letting old perceptions dictate your strategy?
It is definitely time to look at the numbers again.
This has been Delphos Insights. Learn more at delphos.co.